In March of 2020, the world hit pause, and the money printers hit fast forward. Trillions of dollars appeared in weeks like it was the most normal thing in the world. In 2021, governments mailed out checks like the bill would never come due. In 2022, Russia got kicked out of SWIFT, the global financial messaging system, because war isn't just fought with tanks anymore, it's fought with payment rails. In 2023, countries started doing something that would have sounded impossible 10 years ago, trading major commodities in non-dollar currencies. In 2024, central banks bought more gold than almost any year in modern history, not because they suddenly love shiny metal, but because gold doesn't come with a political opinion. And right now, in early 2026, something is happening that shouldn't happen in a normal cycle. Long-term yields are staying high, volatility isn't going away, and the financial system is acting like it's bracing for something. So here's the hook. Listen closely. What if the next recession isn't the real problem? What if the real problem is that the system the recession happens inside is changing? Because when enough signals stack up, it stops looking like a storm. It starts looking like a season change. So here's my question. When does a recession stop being the thing we should worry about? Because a recession is familiar, it's loud, it's the headline everyone knows how to react to. Stocks drop, layoffs spike, the Fed cuts rates, and eventually the cycle resets. But what if this time the cycle isn't the main event? What if the bigger risk is that the rules underneath the cycle are shifting, quietly, while most people keep making plans like nothing changed? And if you're saving, investing, building a retirement plan, this isn't some abstract macro debate. This is personal. Because the difference between a recession and a system shift is simple. A recession can hurt for a year or two, but a structural change can quietly rewrite what your money is worth for the next 20. And if your entire plan depends on the old rules, stable currency, predictable inflation, bonds are safe, markets always recover, then this matters way more than the next CPI print. Look, I'm not saying this to scare you. I'm not here to sell you panic or tell you to cash out your 401k or buy some collapse-proof course from a guy with a rented Lamborghini thumbnail. I'm saying it because I've been managing my own money for over a decade. I've got real skin in the game, money spread across boring index funds, some real estate, and yes, some gold. I'm not guessing. I'm not commenting from the sidelines. And over the last few months, I went down the rabbit hole most people never touch. I'm talking about the stuff that puts you to sleep in 5 minutes, SEC filings from major funds, IMF working papers on reserve currency transitions, Bank for International Settlements reports that feel like they were written by robots for other robots. Because when something big is changing, the truth usually isn't in a tweet. It's buried in the documents nobody reads. And what I found is simple, but it's not comforting. We've been trained to watch for recessions, while the deeper risk is a shift in the system itself. So in the next 15 minutes, I'm going to walk you through the actual mechanics, how monetary systems stress, how trust breaks, why the signals are stacking the way they are right now, and what this means for anyone trying to build wealth or retire in the next 20 years. Not fear, not hype, just the game explained. So let me say it clearly. We're not heading into a recession. We're heading into something structurally different. A recession is a storm inside a system that eventually goes back to normal. But what we're talking about here is the possibility that the system itself is being rewritten. The incentives, the rules, the escape hatches, all of it. And here's why that matters. Your 401k was built for a game that's ending. Stable inflation, predictable bond behavior, a world where the dollar is the unquestioned measuring stick. If that measuring stick starts to bend, even slightly, then the numbers in your account can look fine, while your future gets quietly more expensive. And none of this requires conspiracy. It doesn't even require incompetence. That's not politics. That's incentives. And the consequences? That's not a prediction. That's math. Quick thing before we go deeper. If you've ever used one of those retirement calculators that tells you, congrats, you'll have $2 million, and you felt a little too relieved, you're not alone.
Most of them are built on assumptions that basically boil down to the next 20 years will look like the last 40. So I built a calculator that uses more realistic inputs, inflation that can actually stay elevated, taxes, contribution behavior, and yields that don't magically return to normal just because we want them to. It'll ask for your email so I can send you the link. I don't store your personal financial data. I'm not interested in that. The point is just to give you a tool that reflects the world we're actually living in. If you want it, it's linked below. Now, let's get into the mechanics. To understand what's happening, we need a metaphor we can keep coming back to, because once you see it this way, the headlines stop looking random. Think of the global financial system like a massive commercial lease. After World War II, the world signed a lease with the United States. The terms were simple. The US dollar becomes the global reserve currency. Countries trade oil, commodities, goods, and debt in dollars. Central banks hold dollars. Global contracts get priced in dollars. And in exchange, the United States agrees to be a responsible landlord, meaning keep the currency stable, keep inflation relatively low, maintain security and stability so trade routes stay open and global commerce keeps moving. But here's the thing about long leases. Eventually, the landlord starts taking liberties. Not all at once, not in a dramatic way, just little changes. Fees you didn't agree to, rules you didn't vote for, maintenance that gets delayed, promises that start to get fuzzy. And after enough of that, the tenants start doing what tenants always do. They start looking for other apartments. Maybe they don't move out tomorrow. Maybe they don't slam the door and make a scene, but they quietly start asking the only question that matters. Do we really need to renew this? And once that question shows up, the system is already changing, because the lease isn't just an agreement on paper. The lease is trust, and trust isn't a legal contract, it's a psychological asset. And psychological assets don't collapse all at once. They decay, until one day you realize the building isn't as solid as you assumed. So with that metaphor in mind, let's talk about what the liberties actually were and why the tenants are starting to shop around. So what were the liberties the landlord took? The first big one happened in 1971 when the U.S. closed the gold window. That was the moment the dollar stopped being meaningfully tied to anything tangible. From that point on, the dollar wasn't backed by gold. It was backed by something far fragile, trust. And to be fair, trust worked for a long time. The U.S. had the strongest economy, the strongest military, and the deepest financial markets. The world needed dollars to function, so holding dollars felt safe. But here's the problem. If your currency is backed by trust, then the only thing you can't afford to do is abuse that trust. And over time, the abuse started showing up in the one place that never lies, the debt. The U.S. national debt is now measured in tens of trillions of dollars, but big numbers numb people, so let's make it human. Imagine you earn $60,000 a year and you owe $72,000 on a credit card. That's not, I have a mortgage. That's, I have a manageable payment. That's, I'm living in a hole and I'm pretending the hole is normal. Now you might say, okay, but governments aren't households. True, a government can tax, it can print, it can roll debt, it can survive longer than a person can. But that's where it gets worse, not better. Because when the bill gets too big, you only have two real options. You either pay it honestly or you pay it indirectly. And the indirect method is the oldest trick in the book. You print. Here's the key mechanic most people miss. When the world is excited to buy your debt, everything looks fine. But when buyers start backing away, yields rise, financing gets expensive, the system starts to shake. So what happens when the landlord still needs rent money, but the tenants don't want to pay? The Federal Reserve becomes the buyer of last resort. It steps in and buys treasuries, creating money to do it. That's called monetizing the debt. And you can dress it up with fancy language, but the long-run consequence is always the same. Monetization becomes inflation because you're increasing the supply of money faster than the supply of real goods and productivity. So at the core, this isn't just a debt problem, because debt by itself can be managed. This is a confidence problem. And once confidence starts to wobble, the tenants don't need a full collapse to start moving out. They just need to believe the landlord might not be able or willing to keep the building stable.
Now, if you've ever read Ray Dalio's work on how empires rise and fall, he talks about these big forces that show up again and again. Different centuries, different countries, same pattern. And right now, two of those forces are flashing so loudly it's hard to ignore. Force number one, internal disorder. This is what happens when wealth inequality gets extreme and societies start to fracture. Because inequality isn't just a moral issue, it becomes a financial one. When the gap gets wide enough, politics turns into a fight over the rules. Trust in institutions drops. People stop believing the system is fair. And once that happens, investors start thinking in a very cold, rational way. If this country is becoming unstable, do I really want to lend it money for 10 years at low interest? Because long-term government debt is basically a bet on stability. It's a bet that the government will stay functional. It's a bet that the social contract will hold. It's a bet that policy won't get chaotic. So when people don't trust the politics, they don't lend long-term. They demand higher yields where they leave. And when they leave, they don't just vanish into thin air. They rotate into things that don't depend on political stability. Real assets, commodities, gold, anything that isn't just a promise printed on paper. Force number two, external disorder. This is geopolitical conflict, and more importantly, what countries learn from it. When Russia got kicked out of SWIFT, the message to the world was clear. The dollar system isn't just the global economy, it's a control panel. And once you weaponize that control panel, you create a powerful incentive for everyone else to build a new one. This isn't conspiracy, it's incentives. If you can lock me out of the system, I'm going to build a system that doesn't require your permission. And once that alternative exists, other countries start using it, not because they love the other system, but because they don't want to be next. That's where the psychology gets dangerous, because it works like a bank run. A bank doesn't collapse only because it's broke. It collapses because people think it might be broke, so they pull their money, which makes it broke. Same dynamic here. Reserve currency systems don't end in a single announcement. They weaken through 1,000 small decisions. Countries quietly diversifying, settling trade differently, reducing exposure, until one day the world looks up and realizes the tenants have already been moving out for years. They just didn't call it that. Okay, this can sound big and abstract. Reserve currencies, monetary systems, global flows. So let's make it real. Meet David. David is 42 years old. He earns $110,000 a year. He has $350,000 in his 401k, mostly sitting in a target date fund. He contributes 6% of his salary. His employer matches 3%. David isn't a gambler. He isn't reckless. He did what he was told. And every retirement calculator he's ever used tells him the same comforting story. You're on track to retire at 65 with about $1.8 million. Sounds great, right? Except that math is built on three assumptions, three quiet assumptions that almost nobody questions. Assumption 1, average annual returns stay around 7%. Assumption 2, inflation stays around 2 to 3%. Assumption 3, the dollar David retires with buys roughly the same kind of life the dollar buys today. And here's the problem. If we're moving into a monetary transition, all three assumptions get shaky at the same time. Let's start with inflation because it's the easiest to feel. If inflation averages 5% instead of 2.5% over the next 23 years, David doesn't retire into a future where $1.8 million feels like $1.8 million. He retires into a future where $1.8 million buys what about $800,000 buys today. That's $1 million of purchasing power gone. And the brutal part is David won't see it coming because his 401k statement will still say $1.8 million. The number goes up, but the basket of goods changes. Now here's where it gets even worse. If the world needs fewer dollars, if reserve demand weakens even partially, then the United States has to offer higher interest rates to attract buyers for its debt. Higher rates aren't just a government problem, they're an everything problem.
because higher rates mean lower stock valuations, and higher rates mean bond losses too. David's target date fund is designed to shift toward bonds as he gets older because bonds are supposed to be safe. But bonds aren't safe in a rising rate regime. Bonds lose value when rates rise. That's not a prediction, that's math. So David's plan gets hit from both sides. Inflation erodes what his money can buy, and higher rates reprice the assets he was told were the responsible choice. And this is why what's coming can be worse than a recession, because recessions hurt, but this kind of shift quietly rewrites the value of an entire lifetime of doing everything right.
So what does the United States do if this pressure keeps building? At the highest level, there are really only two paths. Option one is to fix the fundamentals the hard way. Cut spending, raise taxes, rebuild productive capacity, get the debt trajectory under control, restore trust in institutions so people actually want to hold long-term government debt again. In other words, take short-term pain to earn long-term stability. But here's the issue. That solution requires political will. And political will requires leaders who can tolerate being unpopular today so the country can be healthier 10 years from now. In a democracy where most officials are optimizing for the next election cycle, not the next generation, that's not how incentives usually work. Which means, realistically, we end up looking at option two. And this is where it starts to get weird. So, option two is to change the rules of the game. And this is where it gets weird, because once a system starts wobbling, governments don't just fix it, they try to reset it. One possibility is some form of commodity-linked credibility, not a full gold standard where every dollar is redeemable for gold, that's not realistic, but something like issuing treasury bonds that are partially backed by gold reserves or tied to a commodity basket, or structured in a way that signals this is anchored to something real. The goal wouldn't be nostalgia, the goal would be trust. Because if you can convince the world the dollar is tethered to something tangible again, you make the lease attractive to renew. But here's the catch. Even if the U.S. has massive gold reserves, the math is brutal. The debt is so large that backing even a meaningful slice of it would require a dramatic revaluation or a totally different structure. And if confidence is the real asset, then any doubt about what's actually backing the promise makes the whole strategy fragile. Another possibility is a pivot into a digital reserve system. A system where settlement, custody, and reserves become more automated, more trackable, and more programmable, basically a modernized version of global money infrastructure. That could be a central bank-backed digital framework, or it could be something hybrid. And that brings up the third possibility people argue about, usually in a way that sounds insane until you remember how incentives work, a strategic crypto reserve angle. Not crypto replaces money tomorrow, more like if there's even a small chance certain digital assets become part of the reserve ecosystem, then holding them becomes a geopolitical tool, just like holding gold was a geopolitical tool for centuries. If the U.S. ever moved in that direction, strategic holdings, reserve policy, bonds tied to digital collateral, it wouldn't be because the government suddenly became a crypto bro. It would be because reserve status is power, and power follows incentives. But here's the problem with all of these ideas. They require coordination. The U.S. can't unilaterally declare a new monetary system and expect the world to salute and follow. After World War II, it could, because much of the world needed rebuilding, and dollars were the lifeline. Today, the world has options. China is a superpower. Europe is a massive economic bloc. India is rising. Regional alliances are forming. And when the lease is up, the tenants don't have to renew. They can move out, they can negotiate new terms, or they can build an entirely different building. And once that becomes possible, the landlord isn't in total control anymore. And there are two more forces Dalio talks about that people underestimate because they don't feel financial until they accelerate everything financial. Force number 4 is acts of nature. Pandemics, natural disasters, supply shocks, things you can't schedule, but when they hit, they shove the system off balance. We saw it in 2020. COVID didn't just disrupt the economy, it forced governments into emergency decisions that sped up trends that were already happening. Debt expansion, money creation, political strain, supply chain reshoring, global distrust. It didn't create the problems, it hit fast forward on them. And force number 5 is technology, because technology can act like a pressure release valve or a pressure multiplier. Take artificial intelligence. AI might be one of the only deflationary forces powerful enough to push prices down by driving productivity up and lowering the cost of goods and services. In theory, that buys time, but in practice, it also threatens to displace huge numbers of workers, which creates unemployment, instability, and political pressure, feeding right back into internal disorder. So you start to see the pattern. These forces don't arrive one at a time like clean chapters in a book. They stack, they overlap, they amplify each other. And that's why this moment feels different, because it isn't one problem, it's a pileup. Here's the darkly funny part. Imagine you're the Federal Reserve Chair a couple years from now. You walk into a room full of advisors, and everyone has a different version of the same disaster. One guy goes, if we raise rates, we crash the stock market. Another guy goes, if we cut rates, inflation goes back to 10%. A third guy goes, if we do nothing, the bond market revolts. And you're just sitting there like, so what you're telling me is, every button blows something up? I should have taken that job at McKinsey. Or picture the geopolitical side. It's like a poker table where one player has been the dealer for 80 years. And now the dealer says, new rule, mid-hand. At some point, the other players stop arguing about fairness, and they just stop playing. So let's bring it back to the hook. A recession is a cyclical reset inside a system that basically stays the same. Demand drops, companies cut costs, people get laid off, prices cool, the Fed reacts. Eventually, the cycle turns and the economy recovers. We've done that playbook over and over. It's painful, but it's familiar, because even during a recession, the rules are still the rules. The measuring stick stays straight. But a monetary transition is not a storm. It's a structural reset of the system itself. The rules change, the incentives change, and the measuring stick, the thing you use to measure your savings, your returns, your retirement, starts to bend. That's why it can be worse than a recession, because a recession hits you in obvious ways and then it ends. A transition hits you quietly. It shows up as years of slightly higher prices, years of weird market behavior, years where the numbers on your statements look normal, but your future lifestyle shrinks in slow motion. And if your entire plan assumes the old rules, stable inflation, stable currency dominance, bonds acting like a safe haven, then you're not just at risk of a drawdown, you're exposed to the possibility that the game you trained for isn't the game you're playing anymore. So what am I doing about it? Not what I'm recommending for you, not what you must do right now, not some extreme survival plan. Just 3 grounded adjustments I've made because I'd rather respect the risk than ignore it. First, I'm diversifying away from purely dollar-dominated exposure. That doesn't mean I'm selling all my stocks and hiding in a bunker. It means I'm not pretending the only safe plan is everything in one system forever. So I hold a mix, some real assets, some gold, and yes, a small position in Bitcoin. Not because I think Bitcoin is guaranteed to be the future of money, but because if there's even a small chance it becomes part of the reserve ecosystem, the upside is asymmetric. And in a transition, asymmetric bets matter. Second, I'm shortening my duration on fixed income. Long-term bonds are a rough deal right now. If rates go up, you lose. If inflation stays elevated, you lose. If confidence weakens, you lose. So I'd rather keep fixed income short-term treasuries, cash equivalents, things that don't get crushed by a rate regime shift while I wait for clarity.
Third, I'm investing more in skills and businesses that aren't denominated in any currency, because the value of what you can build, solve, sell, or produce doesn't disappear just because the monetary system changes. Currencies fluctuate, but competence compounds. And in a world where the measuring stick might bend, being able to create value is the closest thing to a universal asset. And look, I could be wrong. Maybe the US pulls off a clean reset. Maybe policymakers find a way to stabilize the debt path without breaking confidence. Maybe global competitors decide cooperation is better than fragmentation. Maybe we get another couple decades where the dollar stays dominant and the old playbook keeps working. It's possible. I'm not here to speak in absolutes. But when you stack the incentives, the debt math, the geopolitical shifts, and the behavior of central banks, the direction starts to look less like a random storm and more like a long-term weather pattern. And personally, I'd rather be early and a little annoyed that I adjusted too soon than be late and realize I spent 10 years compounding inside assumptions that stopped being true. Because in markets, being early can cost you comfort, but being late can cost you a decade. And this is the part people misunderstand about monetary transitions. They imagine it like a movie. One day you wake up, the dollar is worthless, everyone's trading canned food, and the internet is full of guys yelling, "I told you so." That's not how it usually happens. It's a slow grind. It's your grocery bill creeping up 5% a year instead of 2%, and you tell yourself it's temporary, until temporary becomes normal. It's your bond fund underperforming year after year, even though you were told bonds are the safe, responsible choice. It's your raises not feeling like raises. It's the quiet realization that the lifestyle you assumed you'd afford at 65 is getting more expensive faster than your plan can keep up. And the cruel part is that it doesn't feel urgent today. It feels manageable. It feels like something you'll deal with later. But later is where the damage shows up, because the damage isn't one big crash. The damage is compounding. And by the time you notice, you've lost a decade of compounding you can't get back. And here's the cruel irony in all of this. The people who get hurt the worst aren't always the reckless ones. It's often the disciplined ones, the ones who did everything right. They saved. They avoided bad debt. They maxed out their 401k. They bought index funds. They believed patience and consistency would be rewarded. And for a long time, that belief was rational, because the system did reward discipline. For roughly 80 years, the rules were stable enough that the boring plan worked. But the hard truth about systems is they don't stay stable forever. They evolve, they adapt, and sometimes they transition. So the risk isn't that discipline stops mattering. The risk is that discipline applied to the wrong rulebook becomes a trap, because you can do everything right inside a game and still lose when the game changes underneath you. So if you take nothing else from this, take this. Stop obsessing over whether we get a recession. A recession is a storm. What we're facing is the possibility of a season change, a shift in the rules, the incentives, and the measuring stick you've been using your whole life. And that brings us back to the metaphor. The global system has been a long commercial lease. For decades, the tenant stayed because the apartment was stable, the utilities worked, and the landlord kept the building running. But now the lease is up, and the tenants are already moving out, quietly, gradually, one decision at a time. And if you're still sitting in the apartment assuming everything will be fine because it's been fine for so long, you're going to be the last one left holding the bag when the landlord turns off the utilities. Peace.